Sean, thank you so much for a thorough and very enlightening presentation. First, we're going to introduce the panel.
Good evening. My name is Benoît Descourtieux. I've been here in Hong Kong since '87, it's about 25 years now, and at the time life was a bit easier because there was no euro in Europe, there was no China stock market as such, and there was no even HKUST, so it was a different world. And we have seen a lot of changes over the last 25 years, and things are getting more complex. I manage money here. I work for a group called Oriental Patron. The group has been around for about 20 years, and I joined them with my own firm 4 years ago, and we invest in the regional markets on behalf of clients that are based in Asia or based in Europe and North America.
My name is Shi Li, and after China's political transition, some of my friends are saying now everybody know how to pronounce your first name. I'm from HKUST. I've work research interest economics, finance, and accounting, and I'm teaching a global finance class as well, global macro investment class as well, and probably will see some of you guys later. I'm proud to say that personally I did predict the 2008 financial crisis and the 2009 rebound as well. Most of the people probably will reserve the predictions for the future for the conclusion. I probably will put my predictions here, which I made early 2011, which is very different from everybody's view at the time. The first one, I believe, is probably the most important is China will slow down from 10% growth to about 3 or 4% growth within 5 years' time, and that will last for a while. I think that will have implication for every one of you guys, and then US will relatively recover, and the European Eurozone will not stay the same, and commodity countries or emerging market like BR Brazil and Russia, and also countries like Australia or Hong Kong will have a big hard time, and housing market in Hong Kong and in China will drop substantially, and as well as global financial markets will stay volatile until this whole global imbalance is resolved. I think those you can make your own judgment, and if you are not happy with it and you can bet against me, we can bet a lunch on that.
My name's Paul Smith. Obviously, I didn't predict the market crash in 2008, or I'd be sitting on my yacht in the Caribbean somewhere. But anyway, maybe I'll get the next one right. I'm a fund manager by training, run money from 1984 through to late this last year. Been here slightly less long than Benoît, came out in '96, was a participant in the last financial crisis in Asia in 1998, which I remember well. I joined the CFA Institute in October of this year to run the Asian operations. The CFA Institute obviously is one of the premier educational establishments in the financial services world. Our view of what's gone on since 2008 is fairly well known. Our desire over the coming years is to be at the forefront of the debate as to how to correct some of the imbalances that have crept into the global financial system over the last 20 years, and we hope to play a major role in fostering that conversation and hopefully bringing about some change for the better in the financial services world going forward.
All right, thank you very much. The first question I'm going to ask Sean. Early on, you showed a chart with the sovereign risk premiums, and it looked, once you got through to the most recent one, that we are at perhaps an inflection point between despair and hope. Now, a lot of us who've been following the European crisis are just wondering, when is it going to end? Is this are we looking at W-shaped, and is this the final upturn, or is it going to be a long-term L?
I think what has happened is that the ECB has finally moved on both fronts to close off the sort of mechanisms that were driving the crisis forward. So it's really addressing the symptoms, but it's not the fundamental solution. What the ECB did was it provided liquidity to the banks, and it promised, and probably will, buy government debt in a way that ensures that the yields stay at a low enough level that debt is seen as sustainable by the markets. Because remember that, and there's a chart on this actually at the end of the presentation, the debt levels in the euro area in aggregate are lower than the UK, US, and well below those in Japan. So the problem is not fundamentally the euro area having too much debt. It's rather the debt is concentrated in regions where there's concern about sustainability. Right? And the ECB broke the negative spiral. But that really just buys time to address the fundamental problems. And these problems require restoring competitiveness and really putting the banking system on a sound basis that can restore confidence in the system in a way that will ensure a return to normality, by which I mean where the market will again be willing to finance banks in Europe without the ECB having to play that role. And this requires what they call the banking union, which is a centralized banking supervision mechanism together with a recapitalization of the banking system. And then there are a range of other institutional reforms that need to be carried out.
Now, one of your other charts, just stay with Sean real briefly. The credit growth chart showed your fastest growth in Vietnam. There was also in China and also in Indonesia. I think most people in this room probably have a tendency towards China. I know I do. Can looking and focusing on China is something we talked about earlier. Their high rate of credit growth, is this something that they will be able to sustain, or should it be sustaining? And then alternatively, in the earlier part before people showed up, we were talking about the other credit market, the shadow banking market that has had pretty strong growth, although there's been a clampdown of late. And what are the risks, some of the risks inherent in allowing that market to be one of the key drivers of credit growth?
China, as everyone I think knows, probably helped rescue the region from the global financial crisis through a massive expansion in credit-funded infrastructure investment. And this really underpinned Chinese growth during the sharp global downturn of 2008. And this is what is reflected in the very large expansion of credit that you see in this chart. But of course, with rapid credit growth comes potential asset quality problems, because you can't lend that amount of credit without making mistakes, lending to areas where that money will be poorly invested and losses will be realized. So there is a lingering concern that credit problems could emerge if growth were to slow down. Now, as some of you will know, NPLs in China are just slightly below 1%. Right? So we don't see credit problems in China. But as we all know, NPLs are very much a lagging indicator, and they are also subject to all sorts of reporting systems. So we don't really know what the situation is going to hold, what the future will hold for the credit quality picture in China. But that has to be a concern, and it is already a concern in financial markets. Because if you look at this chart, you can see the price to book value of Chinese bank equities relative to those in other regions. And what you can see is the Chinese book to equity ratio is close to 1, which essentially means that Chinese banks are going to find it very difficult to raise private equity. And some of you who follow China will know that they are already exploring ways of raising hybrid capital and other forms of non-equity capital. Because in order to support credit growth at the pace that we saw recently, which is, as you can see here, 22.5%, Chinese banks will probably need to raise additional capital. And it may be that going into the future, they will not be able to raise the amount of capital they need to play the central role that they have played in the past. Right? Now we're looking into a crystal ball. But one thing that we have seen in China over the last few years is a rapid growth in the shadow banking system, the non-bank system. And what you see in this chart is the extent to which the shadow banking system has expanded more rapidly than the banking system itself, with growth in the bond market itself has grown at over 50% a year over the first 9 months of this year. And of course, the trust company sector and other parts of the non-bank system have expanded very rapidly. And this is a very, very, you want to have a more diversified financial system. And in fact, probably in China, you need to have that, because the banking system by itself will not be able to sustain the pace of credit and lending that the real economy needs to continue to grow at over 7% for the next decade. So the question is the shadow banking system large enough and sophisticated enough to provide this credit without the buildup of unacceptable asset quality problems of the kind that triggered the global financial crisis in the United States in 2007. But I'm talking about structured products, mortgage-backed securities, and so on. And I think we have some concerns there. They're outlined in our box in the Global Financial Stability Report. And what we say is essentially that the shadow banking system is not badly regulated, but there are real concerns about moral hazard in that sector. And what that means is that a lot of the credit is guaranteed in ways that lead investors to take excessive risks. One example is there has not been a corporate bond default in Chinese history. No bonds, no corporate bonds have defaulted in China. Whenever there's a risk of a corporate bond default, bank steps in and it lends to allow the bank, the corporation, to pay off its bonds. Now, what kind of a bond market is that? Right? So clearly, there has to be change, there has to be development in the non-bank financial sector for it to function, to perform its function of managing risk and allocating credit efficiently to allow the economy